Market crash. Did we have a market crash yesterday, the 19th of July 2021? Was that the case? Well, what is certain is that the S&P 500 lost 1.59% in that session, the session of the 19th of July. It dropped 1.5%, 1.59%, roughly 1.6%, which is 68.67%. That is for one session alone. And over the last five trading sessions, it has lost 122.58%. That's the S&P 500 index. It has lost 122.58%, which is 2.85%. And fortunately, over the last 1 month, it has been up by 0.8%. So it's over. Well, if you look at it over the last five sessions, it has lost a lot because if you're trading things like the S&P futures and also using instruments like maybe trading with instruments in certain domains, like in the UK, for instance, if you're trading with CFDs and spread bets, if you're trading spread betting or spread betting products or CFDs, commission CFDs, commission for difference, and if you're trading such instruments, this 200 and this 2.8% retracement is a lot of money. It's you may have been hit seriously. You may have lost a lot of money already. So if you look at it, if you're trading ETFs, maybe it's just a retracement. You might go back and catch up with it. But if you're trading certain instruments, like I pointed out, it's a huge one. So over the last 1 month, the S&P has been is still up 0.8%. Over the last 6 months, it's up 10.56%. So depending on how far out you got into this market, this is pretty much okay. But for the last five trading sessions, people have lost money. So, but let's see what did the Dow? How did the Dow perform? Let's see, how did the Dow perform? The Dow was also down. It was out down by even more, 2.09%, 725.81% for this last session, the session of the 19th of July. And then for the last five trading sessions, it's been down 2.85%, roughly about the same with the S&P, which is in this case 997.92%. That's depending on the sort of instruments you're trading, that's quite brutal. For the last 1 month, the Dow also not as much as the Nasdaq, as the S&P up 0.25%. Then for the last 6 months, it is up 8.89, also not as much as the S&P 500. And that goes to tell you something about what's going on. The S&P has since been rebalanced. So it is somewhat a better. It tends to, so between the Dow and the S&P, by far S&P is by far a more rewarding instrument to trade. For now, we have evidently seen that over the last 6 months, it's up. The S&P is up about 10%, but the Dow is up about 8.89%. So let's have a look and see what the Nasdaq did. What the Nasdaq did in that session. The Nasdaq was down 1.06%. Okay, not as much. It didn't lose as much as I think of the three of those major indexes, it is the one that lost the least for that session of the 19th of July. So it was down 1.06%, which was a loss of 152.25 points. That was just for that last session. For the last five trading sessions, it has lost 2.99, so 2.99, so which it has lost more than the S&P, probably even more than the Dow. I've just forgotten what I just said now. So it's down 2.99%, which is a loss of 440.15% for the last five trading sessions. For the last 1 month, it's also up 0.9%. So I think it's also beating the Dow. It is beating the Dow in that case. So okay, you see, for the last 6 months, easily the S&P is by far the better. You can see the The Nasdaq over the last 6 months has appreciated by 6.08%. So what does that tell us? It's just simply indicates that of late the inflation fears has affected the Nasdaq. The inflation fears, it tends to affect growth stocks. And we have seen that with some of the instruments we cover on this channel. They have not been doing so wonderfully well, even though they have pretty much done so. But over the last 6 months, we have before the last 6 months, just before the last, we saw many of them skyrocketing and all that stuff. But of late, they're not doing that well as such. Even over the last two trading sessions, the 19th, probably all the way back to the last five trading sessions, some of those instruments have not been doing so well. And you've also noticed that there isn't as many short squeezes going on. The sort of short squeezes we're seeing of late, they're not as steep as we used to see them. Sometimes we used to see up to 600% extensions as a result of short squeezes, but we don't see that much anymore. But they're still going on. We're looking at very low figures of about 20% and all that stuff. So there is a huge sell-off that has been going on, and has affected everything and name it, So, and then you have the 10-year Treasury. It is currently at 1.21%. It lost, I think, crashed down all the way to something as low as yes, probably as low as 1.2%. But now in this, it's currently up and trading. It's up 0.031 points. And what some certain analysts have been pointing out is that what we are looking at right now with what's going on with the 10-year Treasury is as a result of I'm quoting, this is as a result of a softening of the U.S. economy. It's a softening of the U.S., especially the broader market economy, the small caps stocks. It's the mainstream, or rather, how would I put it now? The small cap businesses, they are feeling some softness. That is probably what is behind some of these retracements we're seeing in the 10-year Treasury. I'm only quoting some of these ads, and then some other ones are saying that it may be a case of deflation, but some argue that it's not a case of deflation. It is a case of softening the economy, and it could be that the fact that we are having this problem with employment, the reopening that is going on. I think some businesses, a lot of, especially the small to medium businesses, the SMEs, they're struggling they're kicking off, they're igniting, they're trying to get going, but they're not getting all they're facing supply shocks in labor and products, because even if it's not the case of the resources, the raw materials and the goods, the fact that you don't have you have the reluctance to get back to work from people, yes, definitely that will definitely affect the output that is also their input. So yes, indeed, that is probably one of the cases we are now seeing some of this softness in the economy at the moment. So you can't blame those who are saying it as a case of deflation. You can't blame them, because it's pretty much that. So the opening, the consequence of that lockdown we had, and all the things that happened during that time, the payment protection checks and all those things that many people received, and for so many people it was a good time. It was a very nice long holiday, so. And a lot of things have happened now, and that some of them are really taking their time to get back to work and all that stuff. Some have really found other things to do. Some have found a lot of things to do. We have to point out that our channel really took off during that time. So you can imagine that some other people even found yet more success, yet more. So we're not talking about only a handful of people. With probably up to 1 million people did find ways, did find new things to pursue, and they're probably currently pursuing some of those things. That number is not insignificant. That's not insignificant, and you can imagine that some of them would have also hired also some other people. So we're talking about probably up to, we're just exaggerating here, it could be up to 2 million people, and you don't know how those numbers can affect certain businesses. They can, if it can, it such changes, can affect or may have affected, some certain businesses. Some businesses are quite key to the economy, and if they are affected, the market can get spoofed and all that stuff. Even though in the absolute sense it is not that much of a damage, but we don't exactly know how these things pan out. You can imagine. So yeah, that's what we're looking at right now. A lot of the stocks we're covering and have already covered, even the ones we have position in, they have been retracing. We have I think we have seen up to 25% retracement in the value of our portfolio. Yes, we have seen up to 25%. But that is quite unique to our own sort of portfolio, the way the sort of stocks we bought. But we have seen they are mostly largely small cap stocks. Some of them nano, micro cap stocks. They have been affected by all of these softness and inflation fears, and now deflation fears. We don't even know which one it is anymore. So indeed that may continue. And but in any case, what is certain is that the S&P futures, they are skyrocketing now. They are rising now. It's the S&P futures, as we record this video on the 20th of July 2021, and probably the Eastern US time will be probably 2 a.m. in US Eastern time. So the S&P futures is up at 4,285.27 right now as we record this video. So when there's a retracement, there's also the opportunity. And for some of these analysts, especially the ones that are pointing and saying that we are facing some softness at the moment, but not a deflation, some of them have also, their models have triggered buy signals, buy indications for them to buy the market now, especially buy the S&P futures. So there's a retracement, there is softness and all that stuff, but the buying opportunity is there. So don't sit aside and cry and say things have gone bad. The opportunity is there, and indeed you might say, where's the money? So that still comes to point out that you always have to have some cash left, always have to have some money left on the table. I know it's never easy to say that. It's never easy to say you need to have money always, but you can evidently see that. If you don't have, you can always decide which stock you have to close and see what you're going to buy. And you may ask me now, what next? I mean, how can I trade the S&P 500? Well, if you're in US, for instance, what is available to you amongst other things is these are relatively very much affordable. You can trade the ETFs; they're relatively affordable. But I know that if you want to trade outside the US jurisdiction, it might be illegal for you to trade. I think it's illegal for you to trade CFDs. You can sign up with any UK or any London-based trading platform, but these instruments are really, really risky. They're like trading options, very risky. If there's any loss, if there's any loss, it's gone. You're not getting it back. Unlike stocks, if there's a loss, at least you still have the instrument. There's a chance for you to get back up. But with options and CFDs and spread products, once you have a loss, it's gone. And you traded with leverage, you traded margins, and once the broker cuts your position, it's gone. They're not giving it back to you. You've lost the money. So I'm not really suggesting that you go into that. You can still stick to your ETFs and go from there. They're not really going to yield you a world of money, but at least there's something there, something different, something not as volatile, something not as an instrument that's not as risky. It's good to have it there in your portfolio. And I know some of them may cost a lot, but it's also always good to have that in your portfolio and get going. Okay, so that was just a brief update about what's going on in the market right now. And we'll continue to update you as much as we can. Also, we'll continue to look at other stocks as well. Yeah, so be careful out there. Know what you're doing. Try as much as possible to balance out your portfolio. As we've pointed out, try and include some of these ETFs that are tracking the major indexes. Especially S&P 500. Thank you very much for watching this video.